Welcome you all for today's session. I will talk today on 4 pillars of money management process. First one is E for earn. Second one is S for save. Savings amount should be a significant part of your earning. Third one is I for invest. Your savings need to be invested into a correct instrument. Fourth one is P for protect. You must ensure enough protection for your accumulated wealth. I guess all of you know one common terminology as SIP. This is mostly used in mutual fund investment and known as systematic investment plan. Some people call it ESIP to recognize it as equity SIP. Today, let me help you all to think beyond the investment only. Investment is only possible if you are capable to earn a good amount. Also, you have right mindset to set aside saved amount for proper investment. Only investment does not make much sense if you do not know how to protect. You also need to know the instruments that help hedging and protect your risky investments. So, let me throw the same jargon, ESIP, into a new bottle so that you can concentrate on all the necessary pillars of money-making process. Okay, let me start and explain each of the 4 pillars one by one. First one is E for earn. One must prepare himself to be capable of earning first. Then only we can think of investment, financial freedom, and all other things. Put your focus first on your skill building. That will enable you to earn money. It's not only what you need for living, I am talking about substantial amount of money. Remember, this skill building process should never stop. Always try to earn more, be greedy. Earning more or less is relative. Never get frustrated on what others are earning. If you earn enough, you can save enough. If your savings potential is high, you can invest enough. If your investment portfolio is considerable, it can also grow enough. To summarize, skill building or skill management process is the most important aspect so that you earn enough. Okay, second one is S for save. Old school method of save is understood as spending less. People invest only the part they can save after all the expenses. You need to change the method. Create a new rule for you. Once you get your salary, first invest one fixed part of it. The other part is for your expenses. Can you follow that? Your savings should not be earning minus expenses. Your expense should be earning minus savings. This simple change will make your investment process mandatory and expense process is discretionary. Remember, discipline of investment is your liability, not your wish. Thumb rule is, you must save 20% of your earnings during the start of your career. When you grow professionally, you need to increase the savings, not the spendings. Absolutely no excuse like, I got married, my family increased, or things like that. People who are able to take early retirement sometimes save 90% of their earning for few years. Does it sound insane? Absolutely not. I will cover in other video on FIRE formula. You will understand better the power of savings for your financial independence. So, if I now summarize the S part. Look to save more and invest more. Saving potential is more important than earning potential. Next step is I means investment. There are numerous ways you can invest your saved money. You can take other experts' advice. I will also suggest few things here. Listen to everyone, but do only what you find correct for you. It's your money, like your baby. You can take care of your baby better than anyone else. Some of the basic things you must consider before taking your investment decisions. 1. Discover your psychology. 2. Be aligned with macroeconomy. 3. Forget your own appetite, you must take calculated risk. 4. Learn financial tools. 5. Invest and trade to grow your money, at least to beat inflation. 6. Never look for astronomical gain. Then, you need to diversify your investment portfolio. But do not over-diversify. 2 major instruments you need to invest. Equity and debt. Generally, financial advisors suggest to take more risk at the start of your career. However, my rule is just opposite. Start with low equity investment, and then increase the percentage of equity in your portfolio. Reason is simple. You must have stability in portfolio first, and you need experience in investing in equity market. There are a lot of myths how to diversify portfolio, like equity and debt ratio according to investor's age. Some invest in gold to beat inflation. Tax friendliness. Land prices never go down. Gov securities are safe. But I would say just 2 things to remember. 1. Never spend on luxuries through borrowed money. 2. Have proper protection on your risky investment. Here are some classifications of the financial instruments. Please note 3 things carefully while putting your money in that basket. First one is type of instrument or asset class. You need to factor that some assets carries with high risk. Those have potential to give high return. Second is liquidity. I must consider whether you can easily liquidate your investment as cash to spend when you require to use that money. And the third one is whether the investment return is fixed or variable. Variable return means you need to consider that for long-term investments. Every instrument carries different risk levels. Never think you will find any asset class that are 100% secured. Remember, you are looking for gain, so naturally you need to take risk, more or less. Never consider that you will settle for risk-free return. Risk-free return is more risky since that return is always less than inflation rate. Mean over a long period you are decaying your wealth. What I want to tell you now, whenever you are invested into any instrument that carries high risk, you must take protection. Okay, here comes the last of ESIP, that is, P, means protection. You need to continuously protect the capital you grow. Hedging is the terminology that is commonly used for the protection of generated wealth. Hedging in fact limits both growth and degrowth of your accumulated wealth. It actually works just like any insurance plan. Future and options as derivative instrument actually can help you on that. These instruments are originally created as hedging instrument. But most of the time traders make the mistake to trade on derivative instruments in isolated way. Derivative trading is super risky since those are leveraged instruments. But it works wonderfully well when they are used to protect downside moves for your equity portfolio. Derivative strategies are like magic plant to protect and grow your wealth. It enables you to generate cash flow if you do not have any other fixed income stream. I will cover mostly option strategies after some time. Stay tuned for that. I guess you will rate today's session as a boring session. But reality is money-making process is always a boring process. It takes time. No heroics can make it faster. Most of the time, obvious things are not executed in order, do not follow discipline. People always make step jumps. I tried to reiterate all the things you know already. You just need to follow must-dos and don'ts at every stage in your money management process. Growing your wealth is nothing less than long-term devotion. That's it for today. Stay connected. Here are the references for you to look at earlier videos. Don't forget to subscribe the channel and hit notification bell.